If you want to look at how well a company is doing, in terms of performance, you look at the income statement. You want to know whether in a particular year the company is making a profit or the company is making a loss. That is performance. Is the company doing well or not doing well? You look at the income statement, okay? But if you want to know how much a company is actually worth right now, you don't look at the income statement. You look at the balance sheet. So the balance sheet is very, very important. It is what shows you how much the company is worth right now from when it was established to date. Whereas the income statement shows you the performance for a particular year, the balance sheet tells you how much the company is worth from when it was created till now. So, if you look at how we frame the heading of the income statement and the balance sheet, they are different. The income statement will say statement of profit or loss and other comprehensive income for the year ended blah, 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 31st December, whatever. But when it comes to the balance sheet, we don't say balance sheet or statement of financial position for the year. No, we don't say that. We say statement of financial position or balance sheet as at 31st December, whatever. That's what we say. You see the difference? So the income statement is telling you about performance for 1 year or for one accounting period. Whereas the statement of financial position, which is called the balance sheet, is telling you how much the company is worth from when it was created till now, how much it is worth right now from inception. So it is very easy to understand the balance sheet. It's very easy to prepare it. Firstly, you need to understand what we call the accounting equation. The accounting equation says assets equals liabilities plus equity. So assets are what the organization owns. But if we are going to define it professionally, in line with International Financial Reporting Standard, the framework, the IASB framework, says an asset is a resource controlled by the entity as a result of a past event from which future economic benefits are expected to flow to the entity. When we define an asset, we don't restrict it to what the organization or what the entity owns. We say the resource that the entity controls. So before you recognize it, you must be able to measure it reliably, and there must be evidence that there will be future economic benefits flowing from that asset to the entity. This is what an asset is. So we say the accounting equation says asset is equal to liability plus equity. Now, liabilities, I'm not going to spend time explaining what a liability is, because the liability is the mirror opposite of an asset. So if you know an asset, the way I explained it, look at the mirror opposite. That is what a liability is. It is what the organization owes, but not just that. Look at the mirror opposite and get it in full the way I explained it. So it's a present obligation of the entity as a result of a past event, the settlement of which will bring about an outflow of resources embodying economic benefits. So you see how the liability is. So then equity is what we contributed, what the shareholders contributed. The capital, that is the equity. So to understand the balance sheet, you need to know that asset is equal to liabilities plus equity. So you have liabilities and equity on one side, and you have assets on the other side. So at the end of the day, at the end of the accounting period, your assets, the total of your assets should be equal to the total of liabilities plus equity. This is what we call the balance sheet. So it has to balance. So your assets, you look at your cash, you look at your cash equivalents, you look at your inventory, you look at what you paid ahead for prepayment, which you have paid for but not yet enjoyed. All these are part of your asset. You look at intangible assets, assets like software, assets like goodwill that you cannot see. They are not physical in nature. All these are assets, but they are things that you can measure reliably, and they bring about an inflow of resources embodying economic benefits to the organization. All these are assets. So you have tangible assets, you have intangible assets, you have current assets and non-current assets. Current assets are the ones that you can realize their money under 1 year, 12 months. And then non-current are the ones that you cannot realize under 1 year, but they'll be more than 1 year. So all the classes of assets, whether they are current assets or non-current assets, you will categorize them and total them to get your assets. That's how we prepare the balance sheet. Then you go to the other side where you have liabilities and equity. Your liabilities, you do the same. You have the current ones. The current ones are the ones that are payable under 1 year. And then the non-current are the ones that are payable after 1 year. All types of classes of them. You have creditors, all those payments and loans that you have taken. Some are short-term loans, some are long-term loans. You put all of them, all forms of liabilities. After you total that, you go to equity. Equity is the capital, the ordinary shares. You have the surpluses, you have the reserves, equity and reserves. By the time you total all of this, you add liability to all these reserves, then you have a total. You compare this total with the total of the asset that you already did on the other side. So when you total all of this together, they should agree. If one side is 500, the other side should be 500. That is what it means to say the balance sheet has balanced. But when you have 500 on the other side, and this side is giving you 300, there is a mistake. It means you have not put everything correctly, because the accounting equation says asset should be exactly equal to the summation of liabilities and equity. So this is how to prepare the balance sheet. My name is Echala Okori. I am the Finance Simplifier. I urge you to subscribe to my YouTube channel to continue to learn for free. Accounting, finance, taxation, auditing, business generally. Learn for free.